Hello and welcome to the TID Water and Power Podcast. I'm your host, Constance Anderson, and on this month's episode, we're discussing prepay bonds. In a time when everything is getting more expensive, TID remains committed to our mission of providing reliable and competitively priced water and power. As such, TID is always exploring ways to ensure the lowest rates for our customer owners. One such way, in recent years, has been prepay deals. These complex financial arrangements will provide TID savings on commodities that the district is already purchasing, such as natural gas to generate power. On this episode, I'm joined by TID Chief Financial Officer and Assistant General Manager of Financial Services, Brian Stubbert, to discuss how prepay bonds work, how the district is leveraging these bonds, and the reason prepay deals make sense for TID. Brian, thank you for joining us.
Thank you for having me.
All right. We are happy to have you back again. The last time you were with us on the podcast was November 2024. And at that time, we were discussing all things rates. But for those who haven't listened to that episode or your episode on the budget process, can you tell us a little bit about your background and how you ended up at TID?
Yeah, sure. Absolutely. I would love to. First, I just want to say it's always a pleasure to be on here with you. You always do such a fantastic job.
Oh, thank you.
It's just really enjoyable participating in this process with you. So,
well, you bring lots of information to share, and we love having you back. So thanks for continuing to accept our invitation.
Yeah, no, you're welcome. So I've been in accounting for over 30 years now, and I started off in public accounting where I did audits of various companies. And then, that was for about 5 years. And then after that, I moved into the private industry for about 11 years, where I worked for food processing plants and food processing facilities. And then after working in the private industry, I actually went to go work for Merced Irrigation District down south. And I started there in the spring of 2011. And so I worked there at Merced Irrigation District from 2011 until December of 2017, in which I, became the Chief Financial Officer and Assistant General Manager here at TID.
Excellent. Very good. All right. So let's start with what are prepay bonds actually?
Before I get into some of the prepay bonds, let me just talk about the traditional bonds that we would normally enter into.
Perfect.
And when we enter into these transactions, we have access to get tax-exempt financing in the capital market, and that's through bonds. And so with that tax-exempt, bond rate, we're actually getting about 1% less than you would if you were to go into the taxable market. And so we've used these, these bonds that we've entered into in the past. We've used these for capital purchases, for a lot of the large projects that we have here around the district. But that's really what that's, for.
Okay. These
prepay bonds are allowing us to use in that same tax-exempt, bond rate, but for something in more of our operations. And this operations would be the actual purchase of the commodities that we would use for, running our, power plants or for the renewable energy that we need to purchase.
Okay.
And so that's where it's like a series of transactions that partner where, somebody will partner, in this instance, us, TID, would partner with a private investor to leverage that tax-exempt status that we have to prepay for an energy commodity that we would have had to have purchased anyways. We, as the tax-exempt partner, TID, we actually will receive those savings. And so this allows us to get a discount on that natural gas that we are purchasing or that renewable power that we are purchasing.
Okay, very good. And you mentioned that the transaction involves this private investor. Is something like this available to any private investor?
No, it's kind of a very unique and niche market. Really, what we're looking for there is typically banks or large insurance companies or those types of very high-end, large investors are the ones that utilize the prepay transaction. So that's just because of the size of the deal.
Okay, very good. So in general, what does the process of going out for these prepay bonds look like? How does that get going?
That's a really good question. First, you need to make sure that you connect with a financial advisor and you need an investment banker.
Okay.
Those are the first two steps that you need going through this process. From there, what you'll do is you'll try to determine a funding participant for the other side of your transaction.
Okay.
And that funding participant, we went through a bid process. And that was, somewhere between 10 to 15 potential funding participants. We would send information out to them. They would send back what they thought they could do as far as a term and as far as a rate. And then we would select the best one that we thought met the needs here at the district.
Okay, great.
And I would say one of the key things on this is that you're entering into a 30-year agreement to purchase this commodity. And so, you already you're going to have to purchase this commodity to begin with, right? I mean, whether it's natural gas. I mean, we have, power plants that we use this natural gas in, or we have renewable power. Well, that's what's coming down the road with the state legislation. So you're already entering into that over this 30-year period. But what it is the market will dictate that initial savings period. And so, you're not going to get your locked in savings for that entire 30 years. It may be a shorter duration. And that's, our first prepay was 10 years is what we had locked in for the initial savings. And then after that first 10 years, we actually have to go back out to market where we will then look for another funding participant at that time.
Okay. And I'm going to ask you some more specific questions about each of the two prepaid deals that TID has entered into specifically, but I want to make sure that I understand that correctly. So the agreement is for a longer term, in this case, 30 years, as you mentioned, but within that, the individual kind of segments of that deal will be much shorter.
That's absolutely correct.
Okay. Very good. And that's based on, like you said, the market kind of dictates that, like what the current going timeline is and what sort of tolerance is in the market right now will determine kind of the length of that shorter time period.
Absolutely. And when we get into the specifics of our two deals, you're going to see that illustrated during that discussion. Awesome.
Okay. All right. So TID has gone out now for prepay bonds twice. Like I said, I'll ask you about that in a minute. But we're not the only ones who are doing this. Are prepay bonds a new thing, or have they been around for a while?
I'm going to go with yes and no on that one. So the prepay bonds have been around for a while. They've been available out there, but just not a lot of people, specifically in California, have really taken advantage of those, except for the last, maybe 5, 6, 7 years.
Okay.
But they have been available since 2003.
All right. So what's kind of spurring this more recent popularity?
First off, we need to get a better understanding of kind of when did this come into place. And so in 2003, the IRS published guidance in their tax code that actually allows municipal utilities or cities to be able to enter into these type of transactions. And there was some criteria in there that you have to meet. It has to be either by a municipal utility or for a municipal utility. And you need to be able to serve 90% to retail customers. And so that will kind of limit the quantity that you're able to do because you can't just do it for this unlimited amount. You need to be able, the power that you are purchasing or the natural gas that you're using that you're converting into power needs to be able to satisfy your retail customers.
Okay.
And it also, this does authorize what's called a commodity swap in this transaction, which is very, very key and very instrumental to allow this type of a transaction to occur.
Okay. And what is meant by a commodity swap?
A commodity swap is when you are taking something that is variable, like the pricing of a commodity. And, that fluctuates, day to day, hour to hour, minute to minute.
Sure.
And what you're doing is you are fixing that pricing for that quantity at a specific period in time.
Okay.
And so we are fixing out that commodity over the entire 30 years at that, that specific period in time, allowing this to go forward because it wouldn't be the transaction that it is if you were worried about that commodity pricing fluctuating, down the road. Like you don't know what it's going to be in 20 years. So what is that? So you need to be able to kind of fix that as you're going through this.
Okay, that makes sense.
So how come people haven't been taking advantage of that, right? That's the big question. If it's been out there and it's such a good deal, why now? Why not then? And so there's a lot of variables that do come into that. But I would say one of the biggest variables is that we were in a very low interest rate environment for a long time.
Okay.
And so the low interest rates, as I mentioned, previously, that it's you're leveraging your tax exempt, rates versus a taxable rate. And so in a low interest rate environment, the difference between that, or the spread between that, is very narrow. But when you have a higher interest rate environment, you actually that widens and creates more of a savings, more of a differential in there. And so I'd say that is one of the biggest reasons. I would say the other reason, specifically here in California, was just trying to make sure that we were able to comply with all of the state regulations and legislation that's gone on related to, power. So for instance, we cannot enter into a 30-year, contract for the quantities that we're talking about that is just purely natural gas. Because we have regulations that is going to be, reducing and limiting the amount of natural gas that we are able to use in the future. And so, we as a state had to figure out, well, how are we going to make these prepay transactions work in situations like that? There's other complexities that had to be, worked out, but that's just one example. And so that just took a little bit of time to work into these deals. And then once we had, that in place, what really happened here was, in that specific example, is there's a conversion option where you can convert from natural gas in a prepay deal. And then after a certain period of time, you can then go to renewable power instead of natural gas.
Okay.
Because as we move away from natural gas as a state, we need to move more towards renewable. So we needed to have that conversion option within the prepay deal itself. And so once that got ironed out and a few other things, it made it a lot easier for California, municipal utilities to be able to participate.
Okay. Yeah, certainly no shortage of regulations to work with and around in California. That's for sure. Now, are these prepay bonds the only way to secure long-term transactions for these energy commodities? And I guess the follow-up question would be, how is a prepay different than a power purchase agreement?
So the prepay is the actual where you get your savings. The power purchase agreement, specifically on the renewable side of things, is what you will use you put those into the prepay agreement. So for instance, we as the district, we have 2 existing power purchase agreements that we put into this deal as far as the quantities in our second deal for our renewable power. One was a solar PPA and the other one was a wind PPA. And so the power purchase agreement, that just defines the dollars and the quantities that you're going to get from your partner. The prepay comes in and actually will give you a discount off of what you're already entering into on your power purchase agreement.
Okay. So as you said before, again, this is a commodity that we are going to purchase anyway, but in entering into this prepay agreement with our partners, that allows us that discounted rate, which comes back to us in the form of savings.
That's correct.
Okay, very good. So it seems like these prepay bonds are really a great opportunity for TID and potentially other utilities, but there must be some challenges or risks involved with them. Can you tell us about that side of the coin?
Yeah, no, absolutely. So some of the challenges or risks is, it's tied to the purchase of a specific commodity. And so, what happens if you don't purchase that commodity? So for instance, we have, natural gas to be used in some of our power plants. Well, what happens if, there's an unexpected outage and we're not able to use that power during that, during that time period, the specified quantity that you thought you were going to use? There needs to be a mechanism in there for you to be able to remediate that and to use that down the road. And so that has been built into it. So we can use that in, future months. We can also buy the equivalent amount of power out on the market that's associated with that. So you have to make sure that those risks and those challenges are all buttoned up in there. That's one example of that. And then what happens if a funding recipient goes bankrupt? And that actually in the very early stages of prepays, not in California, But that actually did happen where the funding recipient did go bankrupt.
Oh, wow.
And what happened on that was the entire deal unwound.
Okay.
And so the utility, which would be, our equivalent, there was no bad repercussions on them because everything unwound and because there was no recourse back to the utility, they were able to put things back together, get new documents in place, and then in about 3, maybe 4 months down the road, they were able to enter into another prepay agreement with a new funding recipient.
Okay.
The next one I think is a key, and that is just more of, it's a psychological challenge, I think, here. And that's where you are actually adding debt to your portfolio.
Okay, that's important.
It is. And so over the 2 deals, we've added almost $1.7 to $1.8 billion worth of debt. It's a different type of debt. It's called non-recourse. But still, when you see a B behind that debt versus an M, that makes a huge difference.
That's significant. Absolutely.
It is. So, but there's lots of contingencies that are in place, that we have in there as I was showing, to make sure what happens when these things go sideways. What do you do? These things have already been worked out throughout the industry. They're put into these agreements so that way it protects everybody involved. And so, one of the other challenges is, what happens? We talked about earlier. Well, we have a 30-year contract, but the initial deal, at least for our deal, first deal, was 10 years. What happens at the end of that 10 years? What if interest rates are different?
Sure, the market could look totally different at that point.
There's always that potential for, lower interest rates, and so that's when you go out and you're refunding down the road, what happens during that case? Well, there is a bottom threshold in each one of these deals, and it's roughly around 5.5%, somewhere in that general ballpark. And so if the savings drops below that threshold, whatever's in the contract, then we as the district have the opportunity to say, we don't want this to go forward, and we can unwind the deal.
Okay. So it's kind of a safety net of sorts. Absolutely.
However, we may say, you know what? I know it says 5%, but you know what? It's 4% is what the savings is that we can actually get. 4.5% or 4% is better than nothing. So we're going to go ahead and we're going to keep that. But maybe we have a shorter duration so we can go back out to market a little bit sooner.
Okay.
And so there's ways to kind of mitigate that. But those are all things you have to address down the road. In our instance, 10 years when we come up for remarketing, because we don't really know, what's going to happen at that time.
Right. Absolutely. And I would have to imagine that there's also a large implication on the staff that is putting all this together, because like you've pointed out just in the short time we've been talking, there are a lot of contingencies to plan for and a lot of what ifs and a lot of scenarios to work through as you're putting this together. Tell us a little bit about kind of what happened on the staff side.
Sure. Now, the easy part was putting the deal together, and that wasn't necessarily easy,
Sure,
But
it doesn't sound like it.
But it was the easier part.
Okay.
Because now, the team, whether that's the accounting team, whether that's the resource planning team, the settlements team, they now need to say, okay, how do we put this in operational? How do we make this work? There was another entity that we had to form in order to make this. And this is called the Central Valley Energy Authority.
Okay.
So now we added another complexity in there that we have to manage between, our, who we're working with on the outside.
Yeah.
We have 2 internal parts of our organization, the Central Valley Energy Authority, as well as TID itself, and making sure that all of the paperwork, making sure that all of the funds transfers, making sure that all of that happens at the appropriate time, that it happens in the appropriate manner and in the appropriate amount.
Yeah.
All that has to work together. And then, as I mentioned, what happens if we don't use the power in a given, time period? Well, that adds some more work to somebody out there because they got to figure out, when are we going to use it down the road and how do we remediate that? So these are all some of the challenges that face kind of the resource planning and the settlements team as well as the accounting team.
Okay. Yeah, that is a lot to keep track of for sure. All right. So as we mentioned, TID has now gone out for prepay bonds twice, once in 2025 and then once earlier this year in 2026. Why did TID wait until 2025 to exercise this option?
One of the reasons has been previously mentioned, and that was the low interest rate environment.
Okay, right.
So, from that perspective, the savings wasn't at a point where we thought that it would be beneficial for us to move forward, and just really wasn't advantageous, at that time. And then also, as I mentioned, previously, that change or that conversion allowing us to go from natural gas to renewables within the deal, that was very important for us because, being in California, we needed to make sure that we complied with, California laws and regulations. And so making sure that we had an avenue to be compliant was incredibly important there. And then the third portion is trying to figure out how all of the renewable energy PPAs are going to be incorporated into these deals.
Okay. So we just kind of waited until that perfect window of opportunity kind of checked all the boxes and made it make sense for TID.
Yes.
Okay. All right. So let's talk a little bit more specifically about the first prepay. And this was the deal that took place in January 2025, correct?
Yeah, that is. It happened right after the first of the year. It was January of 2025. It's a 30-year agreement. We started off for the first 10 years of that was going to be natural gas, and with a conversion factor to go with the ability to switch from natural gas to renewable power after that 10-year mark. And I will say that, on this one, I was pretty pleased with this. We actually did achieve a $93.3 million in savings that's locked in over those 10 years. So that was pretty important.
Let's just hold on that for a minute. $93.3 million savings over the course of the next 10 years.
That's correct.
That's significant. That's
yes.
a chunk of change.
Yeah. That was, a matter of fact, I believe that one still might be not as far as a total dollar amount, but as far as a percent savings. That's the largest percent savings of any deal in California.
Wow, that is incredible. Now, when we're talking about these savings, are these hypothetical savings or are these direct savings? Like, is this, kind of money in our pocket?
No, this is real dollars. I mean, these are direct savings. There's a portion of it that is related to the commodity itself. And then there's a portion of it that's related to a financial rebate side of things. But in total, it equated to $93.3 million over those 10 years. Now, it is not even over those, 10 years. It's around $7.5 million a year, for the first, portion of the, I guess the first 8 to 9 years. And then it really has a big savings in that last year. Okay.
All right. But still, like I said, that's a significant amount of savings. Why did we go with natural gas purchases for the first prepay?
One of the reasons is because it was more straightforward. It was a known quantity of gas to purchase over the next 10 years.
Okay. And why the 10 years? You kind of alluded to this a little bit earlier in our conversation, but why the 10 years specifically for this deal?
Yeah, for us, I wanted to lock in the best savings that I could over the longest period of time. Mm-hmm. And as I mentioned, we went out to our funding participants. We submitted an RFP out there, and they submitted, what they thought those saving levels would be, and they did it for a 6-year, an 8-year, and a 10-year. And so I looked at all of the options, and I thought that the 10 years would be the best savings for the district. And so that's what we did because I wanted to have more surety to make sure that we had the largest savings we could over the longest period of time. Up until this point in time, I would say 7 to 8 years was probably the average for these deals. And so going out and asking for 10 years was, it wasn't unusual, but there hadn't been a lot of deals in that 10-year range, at least in the recent, history. And so we took a little bit of a chance in offering those up to bid, but, it really paid off.
I would say that was a good choice on your part. Well done. All right. So then once this 10-year period is up, what happens at that point?
Well, then we will go back out to market.
Okay.
And so, we will go through this process again where we will send out an RFP. We'll go to those, 10 to 15, different, potential funding participants. They will give us, what they feel that difference, that savings will be over, different periods of time, whether that's 6, 8, 10, whatever the time periods are. And then from there, we will select again to see which one is the best for us as we move forward.
And then, as you mentioned earlier, it just kind of depends on where the market is at that 10-year period when we're looking for the next period of financing. Like you said, it could be a much shorter time frame. It could be another 10-year time frame. It just kind of depends on what the market will bear at that point. Is that correct?
Absolutely. And at that point in time, we may be converting from natural gas to renewable power, because that's around the time when that shift is really transitioning over to the renewable power.
Sure, that makes sense.
The size of our deal, at least, for the first deal, was dependent upon the quantity of natural gas that we were going to be utilizing in 2035, so 10 years out there.
Okay.
And so we end up where we're about 89, 90% of what we are projecting our natural gas usage to be 10 years from now. So we're not capping out on what our current natural gas usage is, but our future natural gas usage. And so I think that's a key component is, we had to structure our deal not for now, but what it's going to be 10 years from now.
Right. Which is a lot of what our resource planning group does on the regular, is kind of estimate what we're going to be needing in the future and looking for ways to secure that.
Absolutely. They were very instrumental in, arriving at that number, because right now we're able to use a lot more natural gas, but as we follow California laws and regulations, that natural gas usage is going to be narrowing.
Yep, absolutely. That makes sense. Okay, so now let's talk a little bit about the more recent prepay, the one that we just completed in at the beginning of 2026.
Yeah, this one we did in February of 2026, and that was a renewable energy prepay. And what we did is we assigned 2 of our power purchase agreements into that.
Okay.
And so one is a wind power purchase agreement and the other one is a solar power purchase agreement. Now, this one is only 8 years. We talked about the first one being 10 years. This one is 8 years. And the savings is a little bit less. It's $48 million versus $93 million.
Again, nothing to sneeze at for sure.
Yeah.
All right. So 48 million still being quite a bit of money. But as you mentioned, less than the 93 million. Why the difference there?
There's 3 main reasons for that. The first one is just the quantities that we put in there. So the megawatt hours that we used was less than that equivalent of, MMBTUs that we use for the natural gas. So that's one of them, is just the quantity. And that dictates the size of the deal.
Makes sense.
So the first deal was closer to $1 billion deal. And the second deal was closer to a $700 million deal. Okay. And so that was part of it. The other one is just, slightly lower interest rates. And then I say the third one is the shorter period, go from 10 years in the first deal to 8 years in the second deal.
All right. And why the renewable energy purchases instead of natural gas like the first deal?
And the reason why is because, as I had mentioned, we had already sized the first deal to be 90% of the natural gas needs that for 2035. And so there wasn't really a whole lot of room in there in order to add more. We also had 2 power purchase agreements that we wanted to incorporate in and bring those into the renewable deals. And so it just kind of was a better fit going with renewable energy versus natural gas.
And because the time periods for each of these are happening at the same time over the next 8 years or the next 10 years, you had already calculated in the first prepay how much of that natural gas we would be using and how much would be needed. So like you said, we didn't need any more of that essentially, but the renewables made a lot more sense for us because we know we're shifting that way in California especially.
Exactly.
Okay, very good. Thanks for that. So again, these are significant savings dollars. How is the district actually planning to use these savings?
Well, we've just experienced a recent rate increase, and so we're going to be using these savings to help mitigate any future rate increases, as well as to help pay for some of the large capital projects that we have. We have a large capital project plan, and so we're going to be utilizing some of these funds in order to help offset some of those costs.
Excellent. So we know we have this large capital budget, 5 years, 10 years out of these substantial projects that the district is going to have to complete to keep TID infrastructure sound and keep us functioning reliably. So instead of potentially having a future rate increase to help fund these large capital projects, we can apply sort of this pool of savings that we're generating from these prepay deals towards those larger capital projects. Is that correct?
It is, but I do want to caution that it might not eliminate a rate increase. It just might reduce the impact of a future rate increase because we don't know what costs and other factors are going to be in play down the road. But it definitely will have an impact when it comes to the size of one. We're hoping it eliminates a rate increase, but we can't promise one way or the other on that.
Sure.
But hopefully it will help mitigate the impact of one.
Definitely offset some of the costs.
Yes.
Very good. Okay. All right. So while the majority of our listeners are TID customers, we also have listeners in the utility space. Any advice for some other utilities that might be looking to enter into one of these prepay deals?
First is I would say, yes, get into the prepay deal. That is the first thing I would recommend. But in order to do that, you need to really, partner with a good financial advisor.
Okay.
They need to have experience in prepay deals. These are very complex deals. There's a lot to them. You need to have a good financial advisor. There's a lot of financial advisors out there, a lot of good financial advisors out there. What we at TID, who we have used, is we have used Michael Berwanger and Dennis Whaley with PFM.
Okay.
They've actually given us some great advice, and this is where you'll see how experience matters. Because on both of our deals, when we were going through and we're trying to get our documents ready to go, they said, you know what? We really think you need to try to move this forward as much as you can. We think there's an opportunity to be had if you move from what we had as our original target date, move that forward a couple of weeks.
Oh, okay. So speed up the process.
Absolutely.
Okay.
So for instance, in the first deal, we were set to go out to market, roughly around Martin Luther King Jr. Day.
Okay.
I think it was around January 18th or 19th that year. And they said, we really think that you should try to be the first one out of the gate coming off of, out of Christmas and New Year's. So the first week of January.
Okay.
So we really pushed in order to make sure that we were able to get this out of the gate. And that was the best deal that we had. And so listening to their advice, that really, really paid off.
Okay.
I would say, and as far as the investment banker, we used Goldman Sachs. You want to have a good investment banker out there. There's three main players. All of them are very good. It's Goldman Sachs, it is RBC, and Morgan Stanley.
Okay.
We use Goldman Sachs. We use Joseph Natoli as well as Gardner Smith with Goldman Sachs, and they did a fantastic job for us. They came in with really good ideas, and that really helped us out as well. I would say the next thing you need to do is you need to talk to your board. We had several workshops for the board, and that was incredibly important. And the reason why, was because we needed to talk through the risks with them. You want your board to be comfortable. You want them to ask questions about the risks. Our board did a great job of making sure that we knew what the risks were, that we knew that the risks were mitigated. The board even went as far as making sure that we had a independent legal opinion from our general counsel, who wasn't involved in this deal, to make sure that we had all of the risks identified.
Okay. Because
they wanted to make sure that this was, everything was absolutely, identified. No stone was unturned.
Right.
We really looked at this. They also wanted to see, how is this going to impact our financial statements? What would the auditors think of this? What are rating agencies going to think of this? All of these things our board was asking questions on. And so we had answers for these, but these are what you want your board to be asking. You want them to feel comfortable because they're going to have to talk to their constituents out there.
Absolutely.
And they want to make sure that their ratepayers feel comfortable with what you're doing, because this is a very complex transaction and it's not just a standard transaction that you would have.
Absolutely.
And then the other thing is you need to make sure that you've taken into account the psychological impact of adding debt to your books. I would say the key on this is that it is not your standard debt. So your normal traditional debt, the repayment of that is pledged by ratepayer funds. With these prepay deals, it is not pledged by ratepayer dollars. What this is pledged by is a obligation to purchase that commodity in the future. In traditional bonds, the revenue that you're collecting from your customers is what you are paying for those bonds.
Sure.
With a prepay bond, you are actually paying for the commodity, and that commodity payment is what's going to repay the bonds.
And as you mentioned, that's a commodity we would be purchasing anyway. So we're kind of double dipping, and it works to our advantage to enter into an agreement like this.
Yes.
Okay. Now, let me ask you, when you were a young accounting undergrad thinking about this as a career, did you ever think that you would be carrying $1.8 billion in debt?
Not in a billion years.
I wouldn't imagine so.
No. And even think that adding $1.8 billion in debt and it being a good thing.
A good idea. Right. Absolutely. But here we are. This is good. All right. So are there plans for more of these prepaid deals in the future for TID?
Yep. Based off of the current load, our purchase needs and debt levels, no.
Okay.
Also, our board was comfortable with 2 deals. I, kind of let them know I was not planning on a 3rd deal, at least at this time. If we have some significant changes in, our customer load, like, we have a large customer come in or something like that, then maybe. But as of this time, no, we are done with 2 deals. And so, hey, $141 million to begin with for the first 8 to 10 years. Hey, I'll take it, and we'll see what we get in the next 20.
Not bad. Not bad at all. And you mentioned getting the board to a place where they were comfortable with this, but I know there were a lot of different departments on staff that contributed to the building of these agreements as well. Who actually was involved?
Yeah, I need to throw a special thank you out there to the accounting department, as well as to resource planning, as well as settlements. Those 3 areas, were instrumental in order to get this deal not only across the finish line, but being able to make sure that it's successful on a day-to-day basis going forward. And so really they deserve a tremendous amount of credit for this. And so I'm just very, very grateful to all of them.
Excellent. And as we've heard so many times on the podcast, TID just really has the most incredibly talented people working here and staff that will go out on a limb and try something new and, kind of innovate with these different ideas, including these prepay bonds. So it sounds like you had a good team working on this.
Absolutely. And I couldn't agree with you more.
Awesome. Okay. So before we let you go, anything else you want to add on with regard to these very successful deals?
Yeah, I just want to add one thing. In a time when, all costs are going up, and household expenses are going up, expenses at the district are going up. It's just a really, really good feeling to be able to provide something that helps offset that, that is able to help mitigate that. And you're actually bringing value to our ratepayers, bringing value to our customers, bringing value to the district. It's just a really good feeling.
That's awesome. Yes. And fulfillment of the district's mission.
Absolutely.
Awesome. Well, thank you, Brian. We really appreciate having you with us today.
Anytime.
Thank you for tuning in to the TID Water and Power Podcast. You can find TID on Facebook at facebook.com/TurlockID, on Instagram at TurlockID, and on LinkedIn as the Turlock Irrigation District. I'm your host, Constance Anderson. We'll see you again next time.